Hello and welcome to Chapter 3, Cost Behavior. So our learning objectives from this chapter is to describe the fixed and the variable cost behavior. We will be looking at analyzing the mixed cost into variable and fixed components, as well as prepare the contribution format income statement. So looking at our cost behavior pattern, so when the management decides to offer new product, they have to predict the demand so they can estimate the revenue, which is easy because the revenue piece is based on the demographics, the selling price per unit, advertising, so on and so forth. But the management must understand the cost to predict the bottom line as well to determine the financial success of that product. So when it comes to raw material, that is easy to identify as the per unit cost is fixed. So we take that per unit fixed cost and multiply that with the estimated number of units. Direct labor can be a little bit more challenging to predict because the considerations in those would be what are the skill sets that you need? Would you need additional training? Would you need to hire new employees? What will be the downtime, maintenance, production processes? Okay, so those things will be considered for your direct labor, which makes it a little bit of a challenging process. But if we think of the indirect labor and indirect material, those are even more challenging. So this chapter is going to highlight how the cost changes as the result of the change in activity level. And for that, we have to understand how our cost behaves. So this will be an attempt on understanding how our cost is behaving. So depending on how the cost responds to changes in the production volume, it could belong to three categories. And on and off, we have discussed these. So variable cost, fixed cost, as well as your mixed cost. So we will be talking about them one more time. So with your variable cost is constant on a per unit level, but the total variable cost will change depending on the activity level. So this is the graphical representation of your variable cost. It's constant on per unit, that does not change, but the total would change because it's tied to the activity level. Now, these are some of the examples of variable costs that you would generally come across. So if you're looking at merchandising companies, that will be the cost of goods sold, which is a variable cost. For manufacturing company, this is direct material, direct labor, and the variable portion of manufacturing overhead, which includes your indirect materials such as lubricant, supplies, and power. So with both of the merchandising and manufacturing companies, selling, general and administrative costs such as commission, clerical cost, invoicing, shipping, all of these are also variable cost. And with the service organizations, we look at supplies, travel, and clerical cost. So the way our fixed cost behaves is the fixed cost is constant on a total dollar level. But depending on the activity, your per unit cost will vary. So if your your activity level is high, then the per unit cost will be low. If the activity level is low, then the per unit cost will be high. So it has inverse relationship with the activity level. Your fixed cost is also called as capacity cost. Now, these can either be seen as committed or discretionary fixed cost. Committed fixed costs are difficult to adjust because these are the things that companies have committed to on a long-term basis, such as depreciation, rent, salaries, property taxes. So they are long-term commitments. They are not as easy to get out of. But on the other side, there are also discretionary fixed costs. These arise from the annual decisions that the management makes, and they are possible to adjust for a shorter time period. Adjusting the discretionary cost might have some impact on the business. For example, if the company decides that they will be cutting or reducing their spend on training cost, given the economic environment, then that will have some impact on the business processes. So some of the other examples of discretionary cost is advertising, research, and development. So E3-1 goes down smooth operates a number of smoothie bars in busy suburb malls. The fixed weekly expense of a smoothie bar is $2,500 and the variable cost per smoothie served is 75 cents. So these are different activity level at 2100 activity level, at 28 and at 35. So the fixed cost, let's say if we are looking at 2100 activity level, the fixed cost still remains 2500. So at 2100 activity level, your fixed cost is still 2500. Your variable cost per unit will be the same, so 75 cents per unit, but multiplied with the activity level of 2100 units gives us a total variable cost of $1,575. So your total cost is the mix of, or the total of your fixed as well as your variable cost. So 2500 plus 1575 gives us total cost of 4075. Now, if we take that total cost and divide that by the activity level, which is 2100 smoothies in this case, your cost per smoothie is $1.94. If we look at the activity level of 2800 smoothies, regardless of what the activity level is, your fixed cost is going to be the same under all of these because it's not tied to the activity level. What will change though is the total variable cost. So 75 cents multiplied with 2800 smoothies gives us a total cost of $2,100. So that's a total cost of 4,600. That 4,600 divided by the 2800 smoothies gives us per unit cost of $1.64. So with 3,500 smoothies, our fixed cost is still remaining the same, but our total variable cost is 75 cents multiplied with 3,500 smoothies, and our total cost then becomes $5,125. So that total cost divided by the activity level gives us per unit smoothie cost of $1.46. So number 2, does the cost per smoothie increase or decrease or remain the same as the number of smoothies served in the week increases? And we have to explain why. So in this case, the relationship is that your per unit cost is going to decrease. So if we look at your activity level, your total cost is being divided or spread over the activity level. As soon as the activity level increases, your per unit cost will decrease. So that brings us to the mixed cost. Now, in the past, we have discussed the mixed cost, and this is the cost that will represent characteristics of both the variable cost as well as your fixed cost. So this will vary directly with changes in the activity level, such as production. So per unit cost varies inversely with the changes in activity level. So one cost element would represent the characteristics of fixed as well as variable. So some of the examples of your mixed cost is your maintenance cost, where the salaries is fixed, but the direct material that is used in production or in maintenance will be the variable piece. The other example could be your utility bills, where there is a fixed portion as well as there is a variable portion. So a mixed cost is also known as the semi-variable cost. So this contains element of both fixed and variable, and the cost formula that we use to represent our mixed cost is y equals a plus bx, where y is your mixed cost, a is our total fixed cost, which is also your intercept, and b is your variable cost per unit, where x is your activity level. So bx will give you the total variable cost. Now, in order to understand our mixed cost, we use different techniques. One of them is account analysis. So the company can classify each account as either variable or fixed based on their prior knowledge. Alternatively, we can use an approach called engineering approach. So this one is the detailed analysis of cost behavior based on an industrial engineer's evaluation of inputs required to carry out a particular activity and the price of those inputs. Okay, so engineers can break down the amount of material that is needed to complete that process, material or time, and then allocate cost to that. This can be a time-consuming process as um, as well as expensive. The third approach to understand our mixed cost is your diagnostics. So diagnostic is technique to split the mixed cost into variable and fixed cost portion, assuming there is linear relationship. So example 3-6 with this one is based on our account analysis. So Anand Limited manufactures drones for industrial use. Most of their costs are either through variable cost or fixed cost. However, an account analysis shows the following items are mixed cost. So we have production supervisors. Total cost in 2016 was $150,000. Out of that, 80% is determined to be fixed, meaning the other 20% must be variable. Utilities cost is a total of $60,000. 20% fixed and remaining 80% would be variable. Sales staff salaries, $200,000, 70% of that is fixed, and quality control inspection, $40,000, where 90% is fixed. So 30% of the variable portion relates to sales commission based on the total sales for the sales staff wages. And for the quality control inspection, 50% of manufactured units are inspected each year. So in 2016, Anand Limited produced and sold 500 drones at $2,000 each. Now, if we do the account analysis, we can actually break down these accounts or the amounts between fixed and variable. So in 2016, the total cost for production supervisor is $150,000. Now, out of that, the account analysis indicates that 80% is fixed cost, which is $120,000. 150,000 minus the fixed portion will mean that the total variable cost is the remainder, which is $30,000 in this case. So those $30,000 divided by 500 drones that were produced gives us the variable cost per unit of $60 per unit. So the way the variable cost is going to behave is per unit is fixed, but the total would change. On the other side, with the fixed cost, the total would be fixed, but the per unit will change based on the production or the activity level. So we are doing the same with the utilities. Total utility cost is $60,000. 20% of that is fixed, which is $12,000. The remaining $48,000 becomes variable, and that $48,000 divided by 500 drones gives us per unit cost of $96. With the sales staff wages out of the $200,000 cost, 70% of that, which is $140,000, is fixed. The other $60,000 is variable, which we used to calculate the per unit cost. Quality control inspection total cost is $40,000. 90% of that is $36,000, which is fixed. The remaining $4,000 is the variable cost, and that $4,000 variable cost divided by 500 units gives us per unit variable cost of $8. So management expects to sell 700 drones in 2017. Does not anticipate any cost increases due to inflation and plans to maintain the sales price of $2,000 per drone. Estimate total cost for each of the mixed cost items above. Be sure to show your variable and fixed component of the total cost. So if we are estimating to produce 700 units, our fixed cost is still going to be the same. That is $120,000 for product supervision salaries. Now your variable cost was $60 per unit. So that $60 per unit multiplied with 700 units we are producing gives us a total variable cost of $42,000, and the total of fixed and variable cost gives us a total of $162,000. With the utilities, the fixed piece was $12,000. The variable piece was $96 per unit. That multiplied with 700 units gives us total variable cost of $67,200, and our total cost is $79,200. Sales staff wages, the total fixed cost is $140,000. The variable cost per unit does not change. That was $120,000 per unit sold, multiplied with 700 units produced and sold, gives us total variable cost of $84,000. And finally, with your quality control, $36,000 is the fixed piece. Variable piece is $8 per unit multiplied with 700 units, gives us $5,600, and the total cost is $41,600. Looking at our diagnostic approaches. So there are three approaches that we can use for the diagnostics, which is your scattergram plots, high-low method, and the least square regression. So with your scattergram plots, so these plots depend variable, that is your mixed cost, on y-axis, and independent variable, which is your direct labor hours, on the x-axis. So your y-axis and the x-axis. So we are taking our data points and plotting them on the scattergram. Then we approximate a line of best fit through the scatter plots, extend to y-axis to estimate the intercept, which is your fixed cost, and the slope, which is your variable cost per unit. Now, this method usually helps identify if a linear relationship exists between the mixed cost and the independent variables. So we will look at an example of scattergram plots in class. Okay, the second method is the high-low method. So with this method, we identify the high and the low activity levels and associated total cost. Then we calculate the difference between the activity level and the cost. The change represents the increase in the cost due to change in activity level, which is variable. And that information is then used to compute our slope, which is B, and it's used to calculate the intercept, that's A. So your fixed cost equals your total cost minus your total variable cost. And your variable cost is the change in the cost divided by change in activity level. So looking at example 3-8, so the number of blood tests performed and the related cost over the last 9 months in Brentline Hospital are given. So they have provided us information from January to September with regards to number of blood tests performed and the blood test cost. So using the high-low method, we are estimating the cost formula for blood test. So we are going to pick the high point and the low point. But before that, do know that your blood test performed is your X variable, and the blood test cost, which is your dollar amount, is your Y variable. Your Y would always be in dollars. Now we will pick the high and the low activity point. So in February, our highest was 3,500 blood tests that cost us 14,500, and our lowest activity was in the month of June, where we did 1,500 blood tests that cost us $8,500. Always make sure to pick your high and low from the X column or the activity level. So if we look at your high and low activity level and the total dollar amount associated with those, the difference in these between the high and the low points gives us 2,000 blood work that were different between the high and the low point, and that cost us $6,000. So now we can use this variable to calculate our variable cost per unit. So $6,000 divided by 2,000 unit gives us per unit cost of $3 per unit or per blood test. Now we can take this data and apply that to either the high data point or the low data point to calculate our fixed cost. So in this case, we have taken low point, which is June, where we performed 1,500 tests. So 1,500 tests multiplied with $3 per test. Okay, A is your fixed cost that we are trying to determine, but your total mixed cost is $8,500. So if we use this cost formula, then we are able to calculate our fixed cost of $4,000. Now the cost formula for your blood test would be Y, which is your mixed cost, equals $4,000, that's your fixed cost or your A, plus 3x. 3 is your variable cost per unit and x is your activity level. Using the cost formula you derived above, what blood test cost would you expect to be incurred during a month in which 2,300 blood tests are performed? So if the company is estimating to perform 2,300 blood tests, then your X is 2,300. That's your activity level. Our fixed cost is not changing. So if we plug this information into our cost formula, that is Y equals A plus BX. So Y equals, your fixed cost is $4,000 plus your variable cost per unit of $3 multiplied with 2,300 blood tests. Our total mixed cost at that activity level will be $10,900. Okay, now we are looking at least square regression. So the least square regression is covered in appendix, and I have posted appropriate material for that on Blackboard, so please do make sure to review that. So if we are using to calculate our BA2 plus calculators to for calculations, then please make sure to review this link. Alternatively, we can calculate this by hand, and here is the link on how to do that. Please do make sure to watch these videos. It's an absolute must. The easiest though will be to use Excel. So if we are using Excel, then we can calculate our slope, which is P or the variable cost per unit, by a function called as linest. So all we got to do is use that function linest and select our X and Y ranges, and Excel will give us the variable cost per unit or your slope. And the fixed cost, which is your A for the period, can be calculated by using the function called intercept. We will be looking at details of that in class as well, but here is the same example E3-8 that was adapted. So we have the same number, same data set, same blood tests that were performed and the total blood test cost. But here we are using the least square regression method to estimate the cost formula for blood tests. So if we use Excel to use our functions, then we can derive the fixed cost as well as your variable cost. So for fixed cost, we will use the formula of intercept. So if we apply that formula, then our fixed cost for the month works out to be $3,509. And if we use the function of linest, then our variable cost per test calculated is $3.21. So our cost formula here then would be Y equals the fixed cost of $3,509 plus the variable cost of 3.2164 multiplied with the activity level, which is X. So using the cost formula you derived above, what blood test cost would you expect to be incurred during the month in which 2,300 blood tests are performed? So once we derive our cost formula of Y equals 3,509 or $3,509 plus our variable cost of 3.2164, multiply that with the number of blood tests, gives us total mixed cost of $10,900. $906. Okay, so once again, keep in mind when we are looking at our mixed cost, the fixed and the variable cost. So the fixed portion of the cost represents the basic minimum cost of having an activity ready and available for use. Even if we did not use that, the fixed cost still remains the same. But on the other side, your variable portion represents the cost incurred for the actual consumption of that activity. So if your activity level was 0, then your total variable cost will be 0. But the same idea does not apply to the fixed cost. So the last thing we are looking at here is your contribution format income statement. So this is an income statement in which the cost is presented into two separate sections of variable category and the fixed category. So that is your contribution format income statement. Your contribution margin then refers to the excess of sales revenue over total variable cost. So your contribution format income statement needs to have 3 columns for total dollars, for dollar per unit cost, and percent of sales. So it's going to look something like this. So where we have 3 columns for total, per unit, and percent of sales. So in the first half, we are looking at our sales, less your variable expenses. So sales minus your variable expenses gives you your contribution margin. Out of that contribution margin comes out your fixed expenses. So that's your operating income or a loss. In this case, it's an income of $5,000. Another example, so Alice Jones is the financial analyst at Northjet Air Charters NAC. She is examining the behavior of the operating cost for budgeting purposes. The operating cost consists of 3 types of cost. So there is a variable operating cost such as jet fuel, which is $14 per kilometer flown. We have fixed operating costs such as air crew salaries of $110,000 per month. And C is our mixed operating costs such as aircraft maintenance. Alice has obtained the following cost for the past 6 months. So we have the kilometers flown and the total operating cost from January to June. Now that total operating cost, guys, keep in mind is made up of A, B, and C that's stated. So under the required, using the high-low method, estimate the cost formula for mixed maintenance. Now, if we are using the high-low method, the first thing we are going to do is to look at our activity level and find our high and low activity months. So in this case, our lowest activity month was in the month of January, where we flew 10,000 kilometers for a total cost of $360,000. And our high was in the month of May, where we flew 19,000 kilometers with a total cost of $576,000. Once we get our high and low data points, then we can calculate the difference between the kilometers as well as the dollar value or the cost. So our cost differential between the high and the low point is 216,000 here, for additional or the difference of 9,000 kilometers between the high and the low point. So if we take $216,000, divide that by the kilometers difference of $9,000, then our total variable cost is $24 per unit. So our total operating cost in January, which is our low month here, so we have applied this to the January or the low activity level. So our total cost was $360,000. So your Y is $360,000. Our fixed cost is what we are trying to calculate, which is your A. But we know that our activity level was 10,000 kilometers and your variable cost per unit is $24. So 10,000 multiplied with 24 will give you the total variable cost. So if we calculate using that formula, your fixed cost, or A, is $120,000. So if we elaborate this further, then your total operating cost is $360,000. Now your total operating cost, the fixed piece of that is $120,000 that you just calculated, and your variable cost is $24 per kilometer. From the information that was already provided under B, they had told us that the fixed operating cost was $110,000 per kilometer. And under A, they had told us that the variable cost is $14 per kilometer for jet fuel. So if we account for all of this information, then the difference is $10,000 of fixed cost, which is in the maintenance cost. Maintenance cost was the mixed cost. So the breakup of that is $10,000 fixed cost and $10 per unit is the variable cost. So the cost formula for the maintenance cost would be Y equals $10,000 plus 10x. 10,000 is the fixed cost and $10 is the cost per unit, the variable cost multiplied with the activity level. Okay, so keep in mind this cost formula is for the maintenance cost, not for the overall operating cost. So NAC expects to fly 17,000 kilometers in July. Prepare a contribution format income statement for July, assuming NAC charges $50 per kilometer flown. Now, with any financial statement, always a good idea to put in the title, name of the business, name of the income statement, and the time period it represents. Then we are going to have 3 columns in this case, since it is contribution format income statement. So there is a column for total dollar, for per unit cost, as well as percent of sales. So we will first start with the sales. So if we are expecting to fly 17,000 kilometers and the selling price or the price is $50 per kilometer, then per unit cost is $50, percent of sales is 100%, and the total dollar value is $50 multiplied with 17,000 kilometers. Then we will look at our variable cost. So the first variable cost that we know of is the jet fuel, which is going to cost us $14 per kilometer flown. So those $14 divided by $50 per unit gives us 28% of our cost is tied into jet fuel. Everything is in relation to your percent of sales or your sales amount. So your total dollar value for jet fuel is $14 multiplied with 17,000 kilometers flown. Then based on our earlier calculations, we said our maintenance cost has 2 pieces, a fixed and a variable piece. So the variable piece of $10 per unit is brought here. So that $10 per unit divided by $50 gives us 20% that is tied into our maintenance cost variable. That is your percent of sales. And the total maintenance cost will be $170,000, which is 17,000 kilometers multiplied with $10. So our total variable cost on a per unit level is $24, which is 48% of the total sales, and our total dollar value is $408,000. That deducted out of your sales revenue of $850,000 gives you your contribution margin of $442,000 on total level, $26 on per unit level, and percent of sales is 52%. Once we have accounted for all of our variable costs, then this 3-column format would not continue because your fixed cost is not tied to the activity level. So now in order to complete our contribution format income statement, we need to account for our fixed cost. So the first one that we knew of is our air crew salaries of $110,000, and the maintenance also had a fixed piece of $10,000 that we are accounting for here. Our total fixed cost is $120,000. That deducted out of your contribution margin of $442,000 leaves us with our operating income of $322,000. Do not show your per unit or percent of sales for fixed cost, as your fixed cost is not tied to the activity level. That, my friends, is chapter 3 for you. Thank you for listening.